Monday, the 1st of December, 2025. That means that we are in the last month of the year on the Gregorian calendar. So happy December to all of you. And for anybody in the markets, whether you're trading Bitcoin or alts or anything else, hope you have a great last month of the year. And as you can see on the markets, Bitcoin and alts started off their week, and their month with a very nice move to the downside overall in many different assets. Right, the asset basically the market is down a nice chunk, and literally it's moving along targets that are very clearly visible on the VREs and Laplace normal distribution levels, and making those moves with distributions and mean reversions on all sorts of different time frames very nicely. Once again, the alpha trading tools are reliable calculators, and that's how we are able to predict with a high degree of certainty the likely direction of an asset on any time frame, especially low time frames, which is what we focus on trading at Alpha Trading, because, well, low time frame trades increase your occurrences of opportunity as long as you remember to trade according to the rules. And those rules are principally guided by, first of all, you have to have great risk management, right? If you don't have any risk management, don't even trade. Like, seriously, that's number one above all else, right? You need to know risk management, and that's what we teach as part of our overall how we teach things at Alpha Trading. It's all about the risk management. And in order to maximize your returns, right, for risk management, and to basically increase your gains over time, what do we tell you constantly? The 3 rules of trading. Number 1, take profit early and often. Number 2, get out of bad trades quickly, so limit your loss. And number 3, do not be emotionally attached to your trades, which is both everything you ever needed to know about trading psychology, which is total BS. The only thing you need to know about trading psychology is don't be emotionally attached to your trades, because if you are emotionally attached to your trades, you're going to get wrecked. And also, don't be emotionally attached to your trades is the best way to make sure that you follow rules number 1 and 2. Because if you don't uh, have that mind, right, have that way of trading, of getting in and out of trades and taking your profits, right, limiting your losses, well, and guess what you're going to be? You're going to be stuck in bad trades. You're going to sit there and watch when your trades go against you, even when you're losing money. And that is not how you should trade. You should only be making money for the most part. Doesn't mean you can never lose a trade. No, of course you're going to lose trades. That's why you have to limit your losses. When you limit your losses, you're losing a trade, but you are doing it in a very limited way, so it doesn't impact you in any significant way. So you can win the vast, overwhelming majority of your trades and win them with a greater percentage that you've lost any of the trades that you've lost. Hello there. What is up? How is everything going? I'm just on a walk and talk here for some minutes, and I'm just talking about the markets and whatnot, what's happening with Bitcoin. Right? We saw new levels for the monthly and the weekly and the daily today on Bitcoin, and those ranges on the weekly and daily have been tested already, which is fantastic. And the week looks great for now to the downside, but that doesn't mean it can't pop back up, because whether it's today or some other day this month, there is very probably going to be a test of the central monthly range. Does it have to happen? No, right? These are probabilities. But if you know how to read the probabilities, if you know how to use our tools, then you understand how those probabilities work, and you understand that, generally speaking, assets will test at some point the monthly ranges, just like they will test weekly ranges on the weekly, on a week, and they will test daily ranges most of the time, the vast overwhelming majority of the time, not just like, 51% of the time. No, the vast overwhelming majority of the time, the assets will test the daily range and the weekly range and the monthly ranges. That's why they are the ranges that they are, right? We don't draw these lines, right? These are calculated according to the distribution levels, which is all based on math. And that math is the relevant math that the high frequency trading firms use. What country am I? I'm in Israel. The high frequency trading firms use these maths in order to run millions of trades per second per bot. And they have gigantic bots that are staffed by many thousands of people around the world 24/7, so that they can keep an eye on the markets and always make sure their systems are running and available to everyone, etc. So that's why we use those maths, because those are the maths that actually run the vast majority of trades on all markets, on all assets, and on all time frames. Right? There's a reason we do that. Like, why would you use a system like traditional technical analysis, which is basically voodoo and throwing darts at a board and hoping you land something? Why would you do that instead of using the maths that the people that actually run most of the trades and win most of the trades against you are doing, right? And by the way, if you think they're not running trades against you, I have news for you, right? Yes, they are obviously competing against each other with different HFT firms going after each other, but they're also going for the retail traders, which is why if you look at retail trading, you'll notice something very specific that happens. Right? The vast overwhelming amount of retail traders get wrecked on their typical $5,000 account. We're talking like 99% of retail traders get wrecked within 3 months usually, sometimes 4 or 5. The reason is because retail traders don't have the leading information that we have and that the HFT firms have. Right? The average retail trader uses traditional technical analysis, so they have no idea what on earth they're even looking at, let alone what to do with it. What did you say here? I already told you what country. I'm walking in Israel, that's what I said. Hello to you. Hi to everyone. Glad to see you. By the way, guys, if you do me a huge favor, please like and subscribe so that I can reach more people. And go ahead and click the notification bell. That'd be great. And obviously share it and leave a comment if you want, if you learn something from this video. So like I said, the VRE levels for the weekly and the daily on assets like Bitcoin, Ethereum, Solana, they've all been tested, right? Even meme coins like Bonk, they've all been tested, but they haven't tested their monthlies. Their new monthly ranges, for the most part, are well above where they currently are. So that means in the case of like Ethereum, last I looked at it maybe a half hour ago, it was down around 2,800 and change. And the monthly range is up at around $3,000, the bottom of it. The top side of it, I think, is like 3,200. Where's that center? I forget if it's a $200 central range or $400, but either way, it doesn't really matter. The point is the bottom of it is a 3K, so it's got to go up to at least there in order to test that. If it doesn't do that, it will not have tested the monthly range, right? If it doesn't run up to there all month. But we'll see how that plays out. Meanwhile, for the day, yes, the volatility all looks pretty much to the downside on these assets, but intraday, there's a lot of volatility on low time frames, with plenty of scalps to the upside and the downside, plenty of distributions and mean reversions. Using the RMLR and the Wolf forecast and the UPM, you can see very easily, very clearly where these assets are and are likely to go in the coming candles, right? So that's why you don't stay in volatile trades for a long time, because it is very likely to go up and down, up and down, up and down. And by that, I mean the volatility and the returns, and therefore the price action will very likely follow, because that's really all price action does. If it does anything, because price is mostly random, yeah? But even in its randomness, price tends to follow the volatility. And the returns, specifically, it follows the returns. Right? Volatility creates the returns. Returns create the price action, if you will. And returns, by the way, funny, because what is volatility? Volatility is the standard deviation of returns. Well, how can you get the standard deviation of returns without knowing the returns? That's not how that works. The standard deviation of returns is the spread between the ask and the bid price. Therefore, volatility, the standard deviation of returns, also known as the variance, which is the spread of data around the mean, which is literally that delta, right? That spread between the ask and the bid. That volatility, that standard deviation of the returns, creates the actualized returns, and the actualized returns creates the actual press action, which follows it, right? That's how that works. Anyway, guys, that's going to do for now. Hope you're doing well wherever you are, whatever you're doing. If it's Cyber Monday where you are and you're in a shopping mode, check out the Alpha Trading group at alphatradinghq.com/discord. Go check out the Shop Alpha channel in there. It's amazing. Insane deals right now if you're actually interested in learning how to trade properly using the tools I just mentioned and more. You can come get free tools as well in there. Go to alphatradinghq.com/discord. Until the next one, guys. Peace.